Hello and welcome to Edison TV. Today I'm joined by Martin Davis, CEO of Molten Ventures, one of the most active venture capital firms in Europe. The company is focused on developing and investing in disruptive, high-growth technology businesses. The company is listed on the London Stock Exchange and is currently capitalised at around £490 million, which is around about 1/3 of the company's gross portfolio value of £1.45 billion as of the 30th of September. Martin, many thanks for joining us today.
Morning.
And you've just released your interim trading update. Can you start by discussing, I guess, the key highlights of that update for investors?
Yes, of course. We've had a reduction in value across the board, really, which is really reflecting the reduction we've seen in public markets over the last 6 months or so. So that's not a great surprise. We're seeing it right across the board. That reduces our gross portfolio value to 1.45 billion, which is a top line 17% drop in fair value. But we've had some tailwinds, currency tailwinds. Quite a lot of our later stage companies trade get revenue in dollars or in euros, and so therefore we've seen about a 5% tailwind in the strength of the dollar, which means that overall there's a drop in fair value of 12%. Now, this is a portfolio of businesses, and so it is really right across the whole portfolio that we've had taken a really close look and seen that overall 12% drop across the whole portfolio.
Thank you. And as you said, no huge surprises there, given the performance of the markets and of the technology sector in general. However, you have taken a more conservative approach to valuing your portfolio holdings as well. Can you discuss the rationale and the impact of that?
Yeah, I think this isn't really new. We've valued the portfolio. We do it every 6 months. We've done it in the same way that we've always done it. We've always taken quite a prudent approach. Across the board, companies tend to value private companies on last rounds. So when there's been external money that's come in and valued a company, that's how they tend to set the value. Quite often that can be with a view about future revenue. So we do take a slightly conservative approach. We tend to look at the revenues and the trajectory of the business today, and then we walk it up over a period of time. So what that means is that we do carry some companies at a discount to their last round, because that is, as I say, a slightly more prudent approach, when we like to see those proof points being delivered before we walk those up. So there hasn't really been any great change, but we are taking our usual prudent approach to valuations.
Thank you. And obviously we've moved into an economically much more difficult environment. Obviously all of your companies are different, but can you discuss how this, in general terms, how this environment is likely to impact the value creation trajectory of your holding companies?
Yeah, of course. Look, no one's immune from the current economic environment. It's a global phenomenon. It's affecting all businesses, and so our portfolio companies have been affected, like everybody. And as I said, no one's immune from the current cycle that we're going through. However, what we have seen is that our portfolio is quite resilient. It's quite diverse. We tend not to have that many investments in areas that are heavily dependent on consumer spending or discretionary spending, which might be have a greater adverse effect from the cost of living increase. The core of our companies are much more focused on providing technology to enterprises, and that technology is really there to provide them with increased cost efficiency, general efficiency, risk management, managing their data. Those types of solutions that our companies are providing to enterprises are still as relevant now as they've ever been. And so we've seen a slightly less decline in our revenues from our core companies, really because of the nature of the companies we're investing in. We also invest in deep tech and, for example, in space and climate. Those areas are also slightly more resilient, they're slightly longer term, they look for slightly different proof points. So again, when you look at our whole portfolio across the board, we're nicely diversified. And that diversity does mean that we're able to be slightly more resilient, maybe, to some of the economic headwinds that all companies are facing.
Understood. And how is the current environment changing your appetite for investing into new companies?
Well, our appetite hasn't changed. We continue to want to invest in companies that are disrupting, using technology to disrupt markets and to create new markets. That's happening now as much as it ever has been. There remains a need for technology to make those changes. The advances in technology are continuing despite the economic turmoil we're going through. So the types of companies we invest in, our excitement about the opportunities is exactly the same as before. However, in an environment where interest rates are going up, cost of capital is going up, clearly that means that we have to be more prudent. We have to look at slightly different areas when we're looking to make investments. And as a result, our investment cadence has slowed, and we will make fewer investments this year, and we did over the last 6 months than we have over previous years. I think one of the things we're looking for is inevitably we're looking much more closely at revenue projections in an uncertain economic environment. We're looking much more closely at how costs are being applied within businesses so that they can get to cash flow as quickly as possible, but also to enable them to have as much runway as possible. The cash runway of our portfolio, across our core portfolio, 75% has over 18 months cash runway, which we think is very important. And so when we're looking at companies, we're looking at their ability to manage their cash, and also the cash they're likely to require as they grow. And if the environment remains the same, that's a factor that again is inevitably meaning that we're having a slowdown in our investment cadence.
Understood. And you touched on a little bit of this just now, but in terms of the companies that you look after and you invest into, how is your advice changing, and what advice are you giving to those companies to help them navigate and thrive in this new environment?
Yeah, look, we've got a really great set of companies, and we're still very enthusiastic about their prospects. But they are operating now in a different economic reality, and a lot of the founders, not all of them, quite a lot of our founders have not been through this level of downturn, so they're not running companies, and so therefore we've been helping them to understand how they can manage their costs, how they can extend their runway as long as possible without affecting their growth. Because these are companies that continue to need to grow, they will continue to need to hire, and so therefore we're helping them to recruit the right people, but also to manage their cash flow. As I said earlier on, it's important that these companies have as long a runway as possible to give them the greatest opportunity to be able to trade through the current environment, but also to be able to continue to grow. We do have, as I said, a very exciting set of companies. If you look at the last two downturns, significant downturns we've had over the last 20 years, this vintage could well be one of the best vintages that we have over the next couple of years. Great companies often are formed in periods of downturns. So we're still optimistic, but we're helping our companies to hire well and to preserve their capital. And that's really where the focus of our support to our companies are.
Very interesting. Martin, many thanks for joining us today.
Thank you.